back to the Real Estate Reserve podcast. Jason Bale and Hard Money Bankers, co-host Ian Horowitz at Equity Warehouse, back with another great guest that we're going to introduce to you in a second. He's based out of Hawaii. He's the owner of 10,000 rental units. And we're going to talk about a lot of stuff. We're going to talk about family legacy, which is hopefully kind of the end goal for him. And, definitely a hot topic that Ian and I like to discuss on our show of currently what we do, but more importantly, how he got started, where he is now, and kind of what the goals that Lane has set aside for the future. So definitely looking forward to this episode. Ian, if you're a return viewer, watcher, follower, audience member, thanks again for all your support. Couldn't do it without you. If this is the first time ever tuning in to Real Estate Reserve podcast, what have you been waiting for? We have a lot of fun on this show. We like to bring on great guests that are active operators doing real estate investments, not gurus. So looking forward to this show.
Yeah, I'm definitely excited for this one because it's keeping me off the beach. But I know in our pre-interview, we were talking about fun topics that interest, I know, Jason and I, that everybody will find value in. Guys, if you get any value out of the show, we don't care about the likes or subscribes. That's only for us. We really don't care about that. What we care about is sharing the show. Our guests come in from all over this country that are actual operators doing real deals. And the best compliment we can give them, if you're getting value out of it, is by sharing the show. So enough about us, because this is going to be a jam-packed episode. Why don't we bring in Lane? I'm going to butcher the last name. Let's try it. Kawaoka from Honolulu, Hawaii. What's up, brother? How you doing?
Hey, thanks for having me. I guess aloha, everybody, right?
Yeah, everybody's out there. They are waiting this fun episode. Lane, why don't you just give a quick background about yourself, and then we're going to jump into some fun topics that I know we were discussing before the show.
Yeah, I mean, today, $2 billion plus of past acquisitions. We've played mostly in the multifamily arena, but now in the private equity space, buying businesses too. Part of that is interest rates, but yeah, I wasn't always like this. 2009, bought a house to live in. Thought that was the way to get wealthy. Apparently, that's just what we're all kind of duped to do, along with the 401k, and turned it into a rental property. And kept plugging away at my engineering job until 2015, until I had 11 rental properties. So I started with that turnkey stuff initially.
Yeah, absolutely. And how long did it take you to realize? So let's see. So 2009. You bought that. What did you say? 2015. You were at 11. So we were still kind of, depending on what market some of these properties were in. We're still, in an era where you buy a property, and even if you're not the best executor, you can still make money on it, right? Real estate kept going up, which is a good thing. What happened? Like, what was that one aha moment where you're like, hey, this real estate stuff's working. I need to spend a little bit more time and focus on this.
Yeah, I mean, initially it was just like, I was kind of in a weird situation where I was a construction supervisor, so I was traveling all over for work, rarely home. So that was like the big motivation to just start renting my property out, because it was, I was only home on Saturday. And initially it was like, wow, there's a lot of beer money. Like the rents were $2,200, the mortgage was $1,600. I didn't know anything about the 50% rule back then, or how to do a P&L. It's not too hard on single family homes, obviously, but I didn't know any of that. I didn't have any mentors. Didn't have any, parents never did rental properties. So that went on for maybe about a few months. But then I was like, wait a minute, if I just kept doing this like a bunch more times, I'll be able to quit the rat race and leave my engineering job. And that was kind of when I got serious about it.
So before you left your engineering job, did your 11 houses outperform your salary, or you're like, yo, this is it, I gotta go?
No. I think the 11 homes maybe got me a few grand a month after expenses and, saving up money for CapEx. And that's the problem, right? Like, I got paid too much. I was barely getting maybe a third or not even half of my salary, but it was enough for proof of concept, right? Because I've done that. It took a while, right? Like, I bought my duplex a couple years later, because I wasn't doing any kind of wholesaling or flipping or value add back then. It was just constrained to how much money I could save. So it grew like grass for the first several years. And that's I guess one takeaway for people is like, this portfolio building before reaching the hockey stick takes a while.
Yeah, no doubt. But you saw the light at the end of the tunnel, and you're like, hey, I'm working full time, and I'm still doing all this, and I'm making this money. Imagine if I could clear my brain completely, not have to work at this engineering job. I can go all in on this and be a lot more successful. So you're in Hawaii. Were any of these properties in Hawaii, or when you started, were they all in other areas?
So at the time, I was living in Seattle, Washington.
Got it.
Still a primary market where the numbers aren't going to work out there. It's kind of like California. It's also a pretty big blue state too, with those types of laws there. I initially started off. Alexa off. Sorry about that. I initially started off buying properties in 2012 in Birmingham, right? Because the price of properties were going up, the rents didn't go along with it, so I had to go remote. And for most people out there, where you live, not going to have good rental properties nearby, right? You're going to be living in a primary market more than likely if you're like me, who likes to live in nice places like Hawaii and Seattle. So yeah, about midway through, that was when I started picking up properties in Birmingham, Atlanta, and Indianapolis. A lot of these things not even sight unseen, but hey, they're commodities, right? They're little 3-bedroom, 1 baths or 2-bedroom, 2 baths.
So talk about that hurdle to like overcome, right? Because your first property that you're investing in is clear across the country, right? You're in Seattle, you're going down to the Southeast, and you're buying in Birmingham, Alabama, which, the South has its own way of doing things the same way the Mid-Atlantic or, any other part of these country operate. What were your fears of trying to buy? And I know we're going to get into commercial real estate here in a second, but like, what were your fears of buying clear across the country on your first property? Was it more of, well, if I lose, it is what it is. I would lose more money anyway. It's not a big deal. It's worth a shot. Or was it, did you have like other fears of like, how am I going to manage this? How am I going to do all these different things?
I mean, I kind of went up the wealth elevator step by step, right? It's like I had a rental property, I had a property manager, and then I had another one nearby that was a little bit more of a B class, upper end C class. So I was kind of going up this ladder rung by rung. So the next logical step was remote rental property, but the property manager and essentially operation was no different, right? In fact, the numbers were better on these things. So I felt that confidence going in. I feel for guys kind of taking the big step to buying a remote rental first off, right? They don't even have any experience. They can't feel it, touch it themselves. And then also nowadays, like the guys, the credit investors going straight to syndications and private placements as a passive investor, right? That's a big logical step. I had it easy, and I'm like, like other people do this rental property thing sight unseen. Why can't I?
Yeah, no, that definitely makes sense. I think I took a similar path. Jason was taking the similar path and then went back into his business, right? Because I don't think rental properties are for everyone. And I think some of it has the success level. Some of it is your operation and cash generation and revenue generation. To leave single family and to get into commercial real estate, there's this perceived like, all right, it's up there on the silver platter. How do I go get it? How did you knock that down? How did you get to that next quote unquote level and want to continue to persevere? Not just, right? You could have just kept buying single family real estate and have a couple thousand properties all across the country, aggregate them, sell them to private equity, whatever you want to do. How do we make this leap into commercial real estate?
Yeah, I mean, first it was like, well, what are the reasons why not to stick to doing this stuff? So for me, I mean, to give anybody an idea what it is like to have 11 rental properties. Of course, property management managed them all, but I had maybe some type of eviction every other month, some kind of big catastrophe that happened maybe every quarter, like a tree falling in the house, a washout in the basement because of a rainstorm. No big deal on those, but the big ones were those, out of 1 every 3 evictions, it just ended up into a huge tenant trash out, where it was like a $10,000 to $20,000 move out bill to get the property back online. and it just started to become a chore to do those, to manage the manager. And from 11 properties, with $3,000, a few $100s of passive cash flow each, that wasn't really moving the needle for me at the time. Most of my accredited investors, they aspire to something more like $10,000 to $25,000 of passive income. So I would have needed to 3x, 4x that exception rate and unit count. So that was kind of where the motivation came in. It's like, look, I got to go to multifamily. I got to get more scale here. And I was young at the time. I think I was in my early 30s, and I was like, well, might as well just at least start learning this stuff. So started to join a lot of these like multifamily groups out there, paid a lot of money for mentorship and did all that. But it got me in the game, it got me in the ecosystem. There's, the big thing about these multifamily deals is you need the general partnership team to sign for the debt, right? So you need other partners around you. And then I think the big thing I got was I learned how to underwrite deals well. So whether I was going to be a GP, LP, it allowed me to kind of really, see past the facade that I think a lot of investors never get any of this stuff, right? They just get that silly PDF with the map where Costco's at and all this stuff. There's nothing on the deal, right? Like institutional investors don't look at any of this stuff. They look at the P&Ls and the rent rolls and the raw financials.
So when we were talking about multifamily, what size are we talking? Like when you started, like your first one, I mean, is this, a 12 unit building, 100 unit building?
Yeah, good question. There is at least from my humble opinion, there's a bit of a no man's land under 50 to 60 units. Of course, you use your Fannie Mae, Freddie Mac residential loans up to 4 units. That said, there's also a limit at 10 of these loans. So obviously I hit mines, right? That was another thing I didn't mention. But with the multifamily commercial property loans, you typically need to be bigger property, at least several $1 million loan size for it to make sense. And then you talk about economies of scale. Like the big one is getting the leasing agent at the property. With a 50 unit, you're not going to be able to do that. And even better, you need to justify a handyman on staff, right? This is where you get away from all like the $600 plumbing repairs that come through third-party plumbers and other repairmen versus having these guys on staff. And you don't get that until maybe about 80 to 100 units at a property. So, initially, we did a lot of these smaller properties, I would say under 50 unit size like that.
Yeah. And so on those smaller 50 unit size, we have a 76 unit apartment building, and I agree with you completely. If we didn't have all of our other small buildings and residential real estate that surrounds it, it'd be hard to operate a leasing agent and maintenance staff on that site. 76 is kind of like a cutoff. I think you're right. It's probably closer to 100, depending on the dollar value of rent and the class of asset is probably the real cutoff. But talk to us how you finance that first, let's talk about your first multifamily deal. What size is it? How did you finance it? What does all that look like?
Yeah, so 50 unit. I don't remember if it was a Fannie Mae, Freddie Mac. I guess it doesn't really matter, but it was agency financing. You put down about $1 million, so we had to have $1 million capital raise from our non-existent investor lists back then, and yeah, we're off and rolling.
Okay, all right, that makes sense. So you get that up and running. So single family, right? I think most of our audience will relate to this. You go in, you buy the house, survey happens on the back end on title. Nobody knows about it. Nobody does a phase 1. Nobody does a PCR. You just go in, you look at the house. Great, I'm going to buy it. I'm going to rent it out. This is how much I think it's going to cost to fix. You buy this 50 unit. What was your learning lessons in due diligence? And maybe it didn't happen on this property, but like, what was different from buying a single family piece of real estate to buying that 50 unit building, in your opinion, from a due diligence standpoint?
Yeah, I mean the big ones. Like I said, like it's a bigger loan. You need to have the net worth qualifications from your loan guarantors. So that's a task in itself to kind of get those people to sign on the debt, right? That oftentimes that can be a committee. like if all of our net worth here is $5 million each, the three of us can go get a $50 million loan. Maybe that's 150 units, something like that, right? But as far as due diligence, you get the P&Ls and the rent rolls. I mean, it's a little bit different. We've refined it over the years, but P&Ls and rent rolls. So what is that, right? So with multifamily or even buying businesses, right, you typically can get a couple of years of clean financials from a third party, ideally, and you can see what it's been making and also what the expenses have been. So you go line by line, and the big one, obviously, you start with the biggest ones, the income, right? This is where you're going to ideally make some improvements to the property. This particular ones, when we first got access to these, were Class C, so kind of chunky properties, right? But that's when you're starting out, that's all you're going to have access to. And oh, by the way, we would always go after more stabilized assets and not garbage properties. And when you do that, the brokers control these assets. So that's going to be your biggest barrier to getting decent deal flow through a broker when you don't have a track record. Don't believe what the gurus tell you guys. You cannot send a stupid yellow letter to a sophisticated owner who owns an apartment. They're just not going to sell it to you. You're wasting your freaking time doing that type of stuff. Silly guru programs out there, but it just doesn't cut it in commercial real estate, in the apartment space. It's just, think about it, right? You're not selling to some, I mean, I don't really like the idea of wholesaling personally, but we're not going to go there. But yeah, you're just not going to trick some commercial apartment owner to selling your properties for 50 cents on the dollar. It just doesn't happen. You're wasting your time. You're wasting your stamps. But anyway, back to due diligence. We talked about the income, right? You look at comps around and you're seeing, all right, what are they doing to their properties, right? What in commercial real estate, the big difference is you have access to good data from CoStar, Yari, and then brokers, right? So you can, apartments are not special snowflakes, single family homes. They're boxes, essentially. And you can get really, really tight on your comparables in terms of rent per square foot. Even from like $1.18 to $1.23 seems really close, but you can really get it really close because of all this data out there accessible to people in the industry. So you take that and you're like, all right, I think I can bump the income to this much. Of course, there's different ways you can play with the numbers to get there faster and be more aggressive, which is not good, right, for underwriting, or kind of titrating up there in 2 to 3 years, for example. And then you look at the expenses, right? What is a past apartment owner running this thing at? This is where you rely on your past experience, which we didn't have in the beginning, but at the time, we could lean on the property manager, right? No different if you're buying a single family home, right? Their property managers has seen these things happen. They may have never been an investor themselves, but they see these things operate and they kind of can tell you what breaks and where you can fix. So that's where you can kind of verify the expense lines on these P&Ls. And then you go and you get a property inspector, which are a lot better than the single family home guys. And because these guys will actually stand behind some type of construction estimate, which you plug right into your deferred maintenance line items in your analyzer. And that's pretty much from a high level. I mean, what you do when you do these due diligence on these larger assets.
Yeah, dude, you make it sound so simple and so easy, and we know that that's from experience and doing it over and over again. And I think a lot of people lose sight and they make it like, oh my God, I got to do this. Oh my God, I got, like, when we got into storage, it's like, shit, I got to learn how to underwrite again. Whereas you could just look at a single family house and say, well, the one next door you did, or around the corner, or so-and-so did that and got, $200,000. So I know I could get to 210, right? Like it's, that stuff by the back of your hand. Every individual piece of commercial real estate is unique in a way, and you do need to underwrite it and you do need to spend the time. And I love the fact that, because this is what I always talk about when I go on other people's podcasts, is the broker network. I rely heavily on brokers, not only for deal flow, but for value opinions, what improvements we should make. And then guys like Jason, I always relied on the lenders and getting their opinion, because they look at so many more deals than we all get to look at or even have the bandwidth to look at, because it's not our job. We're looking for the best deals, and those guys are looking to generate fee income from doing deals, right? So I think that's always interesting takeaway that I think a lot of people overlook.
What do you think towards the beginning? Did you think it was harder to find really good opportunities or to raise the capital behind it?
Both are super hard. I mean, let's break it down, right? I mean, maybe the easier one is like investors, right? Nobody trusts you. You're starting from scratch. I mean, it was a dogfight to get that first $1 million.
Agreed.
And in the beginning, like these are the people who were also investing in these types of multifamily too. So they were oftentimes kind of the worst investors too, because they just asked a gazillion questions because, you know, they felt like they were wannabe operators too. And they didn't have that much money, right? They put in some money and that was it. That's all they had.
Yeah.
So that was kind of the first cycle of investors, I would say. But yeah, you know, to the you know, you mentioned like the deal flow. The deal flow is the hardest part.
No doubt.
People need to realize that commercial real estate brokers, their number one thing is that the property is going to close, right? Whether it's single family home or commercial property, empathize, put yourself in their situation. So what are they going to do in terms, and in a way, they're the bell at the ball, right? The property is the bell. You know, the least important or the kind of the guy in this whole thing is us, the buyers, right? We want the good deals to be put our way. So the broker holds the cards in a way. So they're going to ideally go to their top buyers, people who are proven to close always first. If that property gets passed, then it eventually goes to the newer guys. So you as a new buyer need to position yourself to be, you know, not some newbie that's going to come in and then talk a lot for 2 or 3 months and then disappear. You also need to demonstrate that you actually know what you're talking about. So even if, and this is more than likely to happen dozens and dozens of times, is the broker's just going to give you garbage initially. And you're going to have to just take it, be respectful, and give them good feedback on the property, why it doesn't work. He still may never work with you because your criteria is just ridiculous in terms of the market and never going to happen. But at least you know what you're talking about. And you have to wait to that off opportunity that the first guy and the first 12 guys just don't pass on the property. This is why, you know, I think, you know, if you're starting out, you might as well just try and start with the Class C stuff, the stuff that the bigger guys just don't want to pass on, you know, and the smaller assets too. Plus, your investor base is small.
Yeah, and it's all a learning situation. It's all a learning tool. And I think starting out, you're trading time for money. And I think as you grow, it's the opposite, right? And I don't think anything's wrong with that. I think you learn a lot by potentially, you know, doing that stuff. I mean, I remember years, you know, 15 years ago, that in essence we were kind of like, oh yeah, these C-class properties, these are the best deals that were ever, you know, these are the best. I want to do these forever. Or even when we were lending money in certain areas, it's like, oh, these are the best. We should do this forever. And it was, you know, we were making good margins on them because they were down and dirty. And we're making good margins because we were spending our active time on working through them. Where now, you know, we can make money passively in much safer investment vehicles. But, you know, and a few other follow-up things of what you said, you know, if somebody's good in finding good opportunities, and I agree, finding money and finding deals is obviously the name of the game, and it's the hardest part to do, but they do somewhat go hand in hand. At least if you're finding good opportunities, good capital should find you, right? Good investors want to be put into good deals. And if they know you found a good deal and they trust you as an operator, you know, there's a higher likelihood that they're going to work with you. And I will say, you know, I hated working with investors that were smarter than me, capital investors that were smarter than me earlier on, because they would say those questions like, what about this? What about this? What about this? But as I look back, some of those were good questions. And I was pissed off because ego-wise, because it was like, this is my deal, not you. I make the rules. You're just here as a passive investor. But every once in a while, you're like, you know what? It is a good question. maybe I got to add that to my due diligence spreadsheet, or maybe I got to add that in because that's a good point and that's a true point. But as you grow, when you're starting, sometimes you don't know what you don't know. So some of these bonehead capital investors, some of them might just be boneheads. Some of them actually are legit to deal with, and you don't really know who's who. But I think it's all the same. I think everyone goes to this natural transition of what you mentioned is you start with the dirtier assets. You kind of grind on them, and then you're like, screw this. This takes a lot of time. There's only so much of a return I can make on these darn things anyways. We move up in the world into better assets.
Mental health return is huge. What, Lane?
I'll say, that's exactly right for us. I mean, I remember there's a couple years before the pandemic, but we had a Class C property. I mean, we moved from Class C to Class B and better, and eventually developed. But I remember being in one property, it was in Texas, and it was like the economic occupancy was 80%. So out of 100 people, you have 20 people who are just deadbeats not paying. Eventually you try and get them out, but we never got them. We just sold the property at that level. But it's a successful project, but that was kind of where, man, this is just too difficult, right? Like there has to be a better way. So exactly to your point, I mean, economic vacancy is a big thing to look at, right? When you're looking at deals, not to say it's not a bad deal too, right? Because when there's hair on it, there's usually huge opportunities for bumping net operating income.
Yeah, that's right. And I think that's what's interesting about, unless you get to a decent portfolio size, a single family, a lot of people don't look at those metrics and try to figure that out. And I think in commercial real estate, that's what you start to see. I think one point that would be really valuable to a lot of the listeners is, obviously you have Wealth Elevator, presumably a community that helps you getting started or being a part of some, commercial real estate. But there's also this like elephant in the room of where the market is. It's September when we're recording this. Powell's supposed to come out and drop rates by a quarter. It doesn't really affect us in a way, but it does also because a lot of us work off treasuries. What's your gut feeling? Where's the market going? Should you get started today? Like, let's talk about a little bit of, I know it's a very vague question, but it's everyone's got a very wide opinion on this topic. So I want to leave it wide open and let you have room to talk about it freely.
Yeah. I mean, just some anecdotes here. I mean, we've seen some of our, from time to time we get appraisals, right? When we're holding. I've seen some properties in a Alabama market where beginning of 2024, the appraisals were like at least 15% lower than it was later in right now. So those are, of course, just data points in one particular submarket, right? But I think that is definitely a sign. Last week, Arbor released a quarterly report of the first quarter of positive market appreciation across the nation. So that's another big sign. So I don't know. I mean, if you allow me the freedom to change my mind, I would probably say last quarter was the bottom of the pricing in terms of the market. And with, I think, what is it today? Like 80% chance that the Fed lowers the rates by a quarter point next time. I mean, I think that's a pretty, more momentum in that side. And yeah, I mean, everybody said that it was going to take 3 or 4 years for the recovery to start to happen. And I think we're starting to see it. That said, long-term prospects, I mean, make no mistake, we're real estate guys and we'll continue to do real estate deals. But, I have some properties where the taxes increased by 2-3 times since we bought it, and insurance tripled, and everything's more expensive. And now with the debt service being so high, these things just, gone are the days of getting double-digit cash flow. That ain't going to happen anymore, even on good deals. Not to say they're not good deals, right? Good deals are what you can value add, right? Not necessarily what they cash flow in the first few years. So where was I going with this? So I was saying that look at the Fed rate. Everybody should have the Chatham Financial Curve and the CME Fed Watch tool bookmarked on their computers. And those things, yeah, everybody's saying Powell's going to drop rates, but they're not going to drop it under like 3% in the next 5 years or maybe in decades. So as I think it was Harold Marks that said, like, we've kind of entered a new era of investing where you're not going to have free money anymore. So gone are the days of 2010 to 2022. That gravy train ended. And for us, we're cash flow investors. We like to look at the P&L and see that free cash flow, or that buffer is what I call it, there in operations. Sure, you can, like a house flip, totally renovate a property or totally renovate a business and bump the NOI or EBITDA. But we like to see that little bit of buffer there just in case the business plan stalls. So, we're actually moving off to doing deals outside of real estate, which are a lot more riskier. But when things go wrong, there's a lot more levers you can pull. So why am I doing this? Well, a lot of my peers are going off into this same direction. And I think I need to expand my diversification in my alternate investment portfolio too. So
Yeah, I got to talk about this little point here, because I think when you look at it, real estate is ability. There's an ability to create it into a business to generate income, right? But then you end up in all this fee income and all these other metrics, and it's like, oh, do you really want to be a fee shop, or like you just talked about creating true cash flow? And then if you look at businesses, and it's like, okay, I sometimes get envious to Jason. I tell him all the time, I'm like, yeah, some days I wonder if I should have went back and started a hard money company, because then you generate active income that you could then put in passive assets that you then control and operate. And I think everybody needs to really just view that as a whole and say, okay, where does real estate fit in your portfolio? And it has a place. And I think the other thing about real estate, there's only so much NOI you can generate out of a 100-unit apartment building or whatever the asset is. You can only force the value so much. But if you grow a business, right, Jason, technically out of us, Lane, Jason has the biggest opportunity because he can grow his hard money lending company clear across the country and he's not bound by property lines. So I find it interesting that you bring it up, because it got talked about a lot in our mastermind over the past several meetups of just like, oh, well, I think I want to go get a business. Well, why? And then the one guy brought it up of like, you can generate more income as you expand, because you're not bound by one piece of property and have to redo it every single time. So I think that's very, very interesting. Lane, one thing we like to ask all of our guests is, what's one book or podcast you think everybody should go check out, read, or you find interesting?
I'm going to go out on a limb here. I'm going to recommend The Wealth Elevator, my book. There's nobody ever talking about the different layers of the wealth building journey, right? There's all these random financial tips out there, but when the heck does it make sense? So I kind of talk about the different levels to wealth building. What do you do when you were like me, when I was an engineer, under $1 million net worth? Well, you buy little rental properties. Then you step up to bigger deals as maybe a passive investor because of the liability. When you've got $1 million or greater, you're actually a bigger target to get sued, right? And then I guess more importantly for the people listening here, what happens when you hit that $4.5 million net worth mark, right? Where in theory, you could get the heck out of real estate and just put it into T-bills or life insurance and cash flow and chill at that point. Or if you want to grab life by the horns and keep going to 8 figures, right? So I always tell people the first step is to get a little self-awareness and figure out where you're at right now. Because if you've got $1 million net worth, you probably don't want to wholesale or flip houses. Probably don't want to be doing that type of stuff, at least from a tax perspective, right? So there's different inflection points to this journey.
Yeah, that's some deep stuff there, and it's a great way to kind of wrap up this whole episode of talking about the wealth elevator and where you're at in your life and what you should be doing to get to each different level. Lane, where's the best place people can find you? They want to grab a copy of this book. They want to learn more about what you're doing.
Yeah, if they grab a copy of The Wealth Elevator on Amazon, just take a screenshot, or I don't know if you have receipts these days, but shoot our team an email and get the free PDF and MP3 if you're like me and you can't read too well. Team@thewealthelevator.com. If you're a accredited investor, they can shoot me an email, lane@thewealthelevator.com. But if not, just look us up, thewealthelevator.com.
Right on. We'll get all that in the show notes for you guys. Guys, if you got any value out of what Lane gave us today, please feel free to share the show. Guy dropped absolute bombs. It's spot on. You guys can tell that he's a real guy doing real deals because he's giving us real information that both Jason and I can verify. And guys, enough of us. We will catch you guys on the next one.
Thanks for tuning in to the Real Estate Reserve Podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.